love the channel and find it useful in becoming a happy retiree. Subscribe today. We're talking money today because we had a drop of over 600 points on the Dow on Friday and a significantly more throughout the week. Kind of a rough week. 1,095 points on the Dow loss in for this past week. So I want to start out today with a story and a reaction I had to this story and why it matters for you as an investor. And you're going to be reading, if you open up the newspaper on Monday or you watch any of the news channels, you're going to say this was the worst week for the Dow in 2 years, and it's going to scare you. And the story that I want to discuss today has to do with a headline that I grabbed right out of a financial publication. And the headline is this: a drop of more than 600 points in the Dow is very, very rare. That was the headline. I don't know if someone from the first or second grade wrote that headline, but it caught my attention, and I immediately said to myself, what a stupid headline. What a ridiculous story to say how rare a point drop like this is. Because really it's typical, it's this typical Wall Street writers. They're going to spin up. They're going to spin up the fear level. They're going to exacerbate what really happened. So we're going to talk through this today, and there are some reasons why the Dow dropped 1,000 points. So for the week, Dow Jones down 4.1% on the week. That's a big move to the downside for just a week. S&P 500 down almost 4% on the week. But there's a lot of context around that, and we're not standing on the edge of a cliff about to go over. This is not the end of the world, but there are an awful lot of reasons why this is happening and why you need to understand kind of where we are in this cycle. So I thought this is a really good place to start. And this is the story of why a headline that grabs out and says, hey, 600 points, it's a mess, it's very rare, it's this scary, ominous headline. I want to go and understand that a whole lot better, because there's a lot of implications on why it matters for you as an investor. So if this week kind of woke you up a little bit, and if you've been lulled to sleep by a market that's barely moved up or down, just slowly gone higher, it's almost been like a CD rate of return, except much better than a CD. But the volatility of a bond for the stock market over the last 2 years, almost no speed bumps. And that changed this week. That's over. And it was a very nice, placid ride while it lasted. But we expected volatility to come back, and it's here. And it came back with a vengeance this week. So it makes you kind of just wake up and think a little bit about, hey, I haven't been really paying attention to my 401k. I haven't been paying attention to my investment accounts. I hadn't been really, I kind of just forgot about it. And today you've woken up a bit. We're kind of diving into this headline that kind of got me irritated. I was actually sitting in a parking lot before going to get takeout pizza at Vinny's in Midtown for my kids. And I saw this on my phone, and I started reading it, and I started writing about it. And the headline is this: a drop of more than 600 points in the Dow is very, very rare, and it's scary. And I realized something after I thought, oh, what a ridiculous story, is that I've talked about something related to what this headline's saying. And it's just finally coming to fruition. The Friday sell-off is a perfect example of the law of large numbers, which is simply just really math. That's all it is. The law of large numbers is just math. There have been 8 other times in the past where the Dow's dropped 600 points or more in a single day. All of that, by the way, happened in the last 18 years. Every single time we get one of these 600-point drops, it's been a more shallow drop than what we just experienced on Friday because of the way the math works. So every single time, if you go back on all those other examples, the other 8 times this has happened, it's been Friday's drop was a much shallower drop on a percentage basis. And the percentage, that's what really counts. That's what really matters. So as the Dow, or any index for that matter, moves higher and higher and higher, 1 point means less and less and less on a percentage basis. And the higher the Dow goes, 100 points, it seems as though it doesn't matter how high the Dow goes. 100 points still creates a headline. Because maybe it's because it's triple digit gains, triple digit losses. But it's not what it used to be. It's not even close to what it used to be. 600 points is not what it used to be. But for some reason, psychologically, we feel as though a triple digit move on the Dow is some major occurrence. And quite frankly, it still might feel like a major occurrence to most people because it wasn't that long ago that 100 points on the Dow or 100-point move on the Dow was a big deal. Give you a couple of examples. If you go back to September of 2008, there was a Monday where the Dow dropped 770 points. That stung because the Dow closed at 10,365. That was almost a 7% drop in a day. That's a big move. Wednesday, October 15th, 2008, Dow dropped 733 points, landing at about 8,600. That was almost an 8% drop in a day. So you go back over the course of history and you look at all the periods of time when the Dow moved lower by 600 points or more, and the percentages were tremendously different than what just happened this week. So this week, a drop of 665 points, that's a 2.5% drop. Nothing to sneeze at. But a 2.5% move, very different than in the past when the Dow has moved in this same point fashion, very different on a percentage basis. Go back to 2009, as the market started to bottom and move higher. 120 points was almost a 2% move. Back in March of 2009, a 600-point move represented, it was 8 or 9%. That would have been an 8 or 9% move in one day. Today, 600 points or 665, like we saw on Friday, was 2.5%. That's a large move in any given day, especially when the average volatility over much of market history has been about 0.75% per day. So 2 or 3%, it's again, nothing to sneeze at, but it's also a very manageable move, manageable drop, and quite frankly, to be expected. It's not welcome though, and that's where the human emotion part of this comes in. It's not welcome. You don't rally or cheer for markets to go down. You don't want to see it, but you have to expect it. So the bottom line here, and I want to go into some of these reasons, but in seeing what has been happening over this past week, the market didn't die last week just because it gave back 4%. Quite the opposite is true. The market's finally alive again. The bucking bronco was asleep for a long time. And there barely a blip since February of 2016. If you look at a chart, there's just the last 2 years, it's been a nice, steady escalator higher. That changed last week. And we are back. The bucking bronco is back. Another couple of statistics here, just to show you how asleep the market was. All right, so let's go back to so the S&P 500 in the beginning of this year, before this week, had gone up by 7.5% in just the first 18 trading days. 18 days in 2018. So that in its own right is a ridiculously rapid move higher in any market. If it were to continue to do that at that same pace, so take it 7.5% in 18 days, the market would go up 158% in 1 year. Never's happened, never even close. So we knew that pace could never be sustainable. And the market, or if you look at the Dow or the S&P 500, it had gone 99 days without a drop of even 0.6%. So this week that happened on Tuesday. Again, it got even bigger on Friday, but that kind of the movement or lack of movement has been unprecedented. And again, the market was asleep. Today, it's awake. It didn't die this week. It actually finally woke up, and that is to be expected. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.